Hey, it's Jim, and this is level 1 of the CFA program, the topic on financial statement analysis, and the learning module on financial reporting quality. Let me give you a direct quote from the first sentence in this learning module. Financial reporting quality varies across companies. This presents us with a challenge. As good financial analysts, maybe we have an annual report that's complete, that's accurate, it looks beautiful, we can thumb through it or we can scroll through it and we can find what we need so that we can make decisions. At the other end of the spectrum, maybe we have some paper or something, maybe they're upside down, maybe there's no color to it, maybe there's no information in there, but the important thing is that that doesn't help us make decisions. And you'll see the emphasis on this kind of a decision-making framework as good financial analysts in these learning outcome statements. Notice the action words, mostly they're describe, but we also have to explain and maybe compare. But look at some of the bolded terms that we have inside of these LOSs: conservative and aggressive accounting, a spectrum, the mechanisms of discipline, presentation choices. All of these things can be summarized by saying something like, look, when a company puts together its financial statements, it needs to make certain that those who read them, whether they're investors, whether they're bankers, whether they're financial analysts, whether they're government officials, that they can understand them and then use them for their own unique purposes. And remember, all those different groups of people, they might have different purposes for looking at the financial statements, but the end result is that somebody has to make a judgment based on what's presented to us in those financial statements. All right, let's go ahead and start with that first LOS, financial reporting quality and the quality of reported results. Think about this as the difference between what is presented and the underlying economic value of the company. I mean, I could run Jim's construction company and I can have an awful economic model and I could be hemorrhaging cash flow and reporting negative earnings all the time, but I could put together an annual report that looks beautiful, has all these different things in it, and it's beautiful, but it's not reflective of the economics of the underlying asset. So make sure you get these definitions. These are some good exam questions here. High quality financial reports. Well, this is exactly what I was saying in the introduction. Information that's relevant, it's complete, it's accurate, it's free from errors, it's all sorts of those good things. But notice the one word in there, and this is going to pop up in lots and lots of slides here, neutral, which means that we can't have a bias upward or we can't have a bias downward. At the other end, let's call these low quality financial reports. How about if we say there's information in there that is entirely fabricated? There's lots of lying and thievery and all sorts of crazy things going on. Now let's move on to this term earning quality. So you'll hear me say this in other learning modules. You'll hear me repeat it in level 2 and in level 3. What's the goal of business? Goal of business, maximize shareholder wealth. How do executives do that? Well, they find projects that have lots and lots of cash flow. But here's the key part of that. Lots and lots of cash flow that is sustainable, which means that a sub-goal of the business is to produce product lines or services that are branded, brand names. So you'll read things like sustainable. Look at this, high quality earnings, likely to continue in the future and provide an adequate return on investment. So this makes perfect sense. Think of all of the branded product lines and services that you use during the course of your day, whether it's laundry detergent, whether it's a brand of coffee, whether it's chocolate that you eat, or whether it's soup that you eat, whatever it is. You know that Milton Hershey has been making chocolate for thousands of years, and he's probably going to be making chocolate for the next 1,000 years. So what does that mean? Hershey's chocolate bars, brand name. So that is an indication of sustainability. So that's earnings quality that's reflective of the underlying economic activities. So look, up in the very top, we have actual economic activities in that sentence. But look under earnings quality, what does it say to it? Reliability, sustainability, earnings, cash flow, balance sheet items. I mean, anything that shows up on those financial statements. Here's a good little matrix that may show up on the exam. Notice we're comparing low and high reporting quality across the top row, and we're comparing high quality of earnings and low quality of earnings on the vertical axis there. And so you can get a sense of, this is what I was saying about those annual reports during my introduction. You can have low quality reporting, but high quality of economic earning activity. And so you have the four choices here. I would just make sure that you know each one of those, because that's at least one good multiple choice question on the exam. Now, what the learning module does is it puts this into a continuum like this. So here's a quality spectrum, and we're going to go through each one of these in the next handful of slides. So I'll just do it quickly here. So you can go from what I think of as almost like the perfect scenario up on the top left, and notice that that's green. I want you to think about that as how you prepared for your first interview after you graduated from college. What did you do? You took a bath, right? And then you brushed your teeth, and you put on some nice clothes and a suit, and you wanted to put on your best presentation, and you practiced, you did some research on the company, you knew who was interviewing you. So your outside was beautiful and your inside was prepared. Your inside was beautiful. That's perfect. All the way down to the bottom right, so that's kind of an off red. This is like, and I'm not suggesting that any of you guys would have done this. I'll use my own example. When I was in college, there were days when I was out late at night and I was doing all sorts of fun things, and I would wake up in the morning and I looked awful, right? And so that's fictitious transactions down there. So really, what do we want? We really want to know who is the real you, who is the real Jim, what is the real company. So of course, the goal as financial analysts is to search for companies that generate financial reports that are going to be up in that top left spectrum. And then we know that we can rely on those things every quarter and every year. But of course, there are lots of companies that are not like that, and they're somewhere down in the middle or down in the bottom right. So let's take a look at a little bit of more details inside of this spectrum. So here we are. This is the perfect scenario where you have high quality of reporting that's coupled with sustainable cash flows that provide the investors, probably the shareholders, but maybe the bondholders, you can throw them in there, with adequate returns. So what are some characteristics? And down in the green here on the left-hand column, these are probably good indications that might show up on a question stem. So they conform to the accounting rules illustrated and developed and demanded by the accounting gods, whether they're in the US GAAP or the International Financial Reporting Standards elsewhere in the world. Embodies characteristics of decision useful. So that's a term. What did I say in my introduction? That we can use these to make decisions for our clients or our research projects. Notice that term conceptual framework, I would know that term for the exam. And then we've got people on the right-hand side of the balance sheet. We've got the bondholders that are demanding a yield to maturity on the bonds. We have shareholders who are demanding a required rate of return. Maybe we could call it an internal rate of return. Maybe we could call it a hurdle rate. I mean, whatever that is, that's what we're looking for, so that the people on the right-hand side of the balance sheet are satisfied. And I'm fascinated by the Institute's use of the term an adequate level of return. Adequate doesn't sound like, fireworks are going off. Adequate sounds like, like we're kind of satisfied. But make sure that you understand that what the Institute is implying here is that adequate level of return means that it's consistent with the level of risk that those investors are taking on the right-hand side of the balance sheet. Just think about it. If the bondholders take this much risk, the shareholders take this much risk, or maybe even this much risk. Now, suppose that we have super high quality reporting. However, those cash flows, maybe those earnings are not sustainable. So we're going to call that low earnings quality. And there's an example down the left-hand side about some profitability that was due to the variability in exchange rates. So we need to be careful and be able to identify whether or not something is repeatable. Now, clearly, in my earlier example with Milton Hershey, the net income and the cash flow stream and probably even the free cash flow stream is, I don't want to say this, fairly predictable, but you know that it's sustainable because Milton Hershey's been around and there's that brand name. So we need to be able to identify those changes on the income statement, whether it's at the top on revenues or whether it's on the left-hand side with expenses, whether those things are sustainable. Now, you guys should know, based on our previous conversations in this financial statement analysis, that the accounting gods, they give the accountants lots and lots of choices. You can do LIFO, you can do FIFO, you can do weighted average depreciation, you can do straight line depreciation, you can do modified accelerated, you can do Jim's depreciation. I don't think Jim's depreciation is according to GAAP, but you can either have an aggressive perspective or a conservative perspective. So these are great exam questions in which the Institute might give you something and say, hey, what we're trying to do is we're trying to select a revenue recognition or an expense recognition method that increases our net income during this coming quarter because of such and such and such and such, whatever that reason might be. So that's an acceptable choice. But what it's going to do is it's going to bias those choices either upwards or downward. And of course, the problem with this is that word obscure. There's an attempt to obscure some maybe unfavorable information or maybe delay that unfavorable information to another time period. You know, when I get to this kind of a part in my undergraduate corporate finance class, and I do this at the MBA level as well, is I always go in front of my students and I'll say this, like, look, the accounting gods give the accountants the ability, and I do this, to massage the data. And massaging the data is making an aggressive choice or making a conservative choice, and that's all legal and bound by all the rules of the accounting gods. But sometimes you manipulate the data, and I go like this, like squeeze, 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 manipulating the data to clearly make it some unfavorable results look more favorable. And there's an example about WorldCom down there with inflated net income. So remember this, that's within the GAAP rules, but there are bias choices. And we're going to talk about that bias here in just a little bit. But then here's where the Institute calls this manipulation. So that's my little scrunching of the paper there. Deliberate actions. So real earnings management and accounting earnings management. We can do both of these things inside of a company to make those results look way better than what they are. Then, of course, you can have non-compliant accounting. And what we'll see in just a slide or two is that, hey, the accounting gods, GAAP especially, says something like, look, if you want to use Jim's depreciation method, have at it. Feel free to present it right there in the annual report. This is Jim's depreciation method, and this is the impact. But then when you turn the page or you scroll down, you must then say, okay, if we did it according to the GAAP rules, then this is the result. But we like Jim's depreciation method better, but we need to make sure that we're consistent so that you guys out there can make all of those comparisons. The Institute does mention Enron and the special purpose vehicles, understate debt and overstate profits. That's clearly not what happened with Enron. Clearly Enron was just making stuff up. And then fictitious transactions. There's a good milk example down there at the bottom. So misrepresentation and fraudulent misappropriation. So I think this is a really good exam question to link this reporting quality with the code and the professional standards by saying something like, hey, here I am, I'm Jim. I am a CPA and I hold the CFA designation and I'm responsible for putting together these financial reports, and I misrepresented or I hid fraudulent misappropriation. So is this a violation? And of course it's a violation of GAAP stuff, but it's also a violation of SEC stuff, but it's a violation of the rules and regulations and the professional standards. Here's a good slide on the difference between aggressive accounting and conservative accounting. Notice we've highlighted the overstated and the understated in both of those. So I think that's probably the very first exam question. And what you might have to do is take a look at those two indented arrow points, try to determine if somebody increases reported performance in the current period and it shows up later as a decrease in performance. Well, that sounds like aggressive accounting. And so be able to identify aggressive or conservative accounting. Now notice we put this in red up at the top. So there's that conceptual framework term that I referred to earlier. The conceptual framework, the accounting gods say something like, let's be neutral. We want to promote neutrality. We don't want the upward bias. We don't want the downward bias. We don't really want you to be conservative. We don't want you to be aggressive. But we know that human nature is such that there's going to be some kind of a bias somewhere in the presentation of this financial information. So be aware that the international people and the US people, they would love to have an annual report presented with no bias. Now, of course, in a perfect world, that would be the case. So what you're likely have to do on the exam is to identify some of those biases. So here's some good examples here. There's impairment. We'll talk about impairment in level 1, level 2, level 3, and then look down at the bottom there, research cost, litigation, and then something about receivables. So be able to answer a question that says something like, hey, what about if we expense these costs today and we don't capitalize them over time? We have that choice. And what about how we view impairment? Think about Milton Hershey. What would Milton Hershey have to do to impair, whether it's the physical assets or the intangible assets? Well, we would have to just stop eating chocolate. And we know that that's not going to be possible, right? We have our fixed amount of chocolate that we buy during the course of the year. We're probably not going to buy more. We're probably not going to buy less. That's why branded product lines are in that mature stage and they don't have lots and lots of growth, which of course is why Milton Hershey then does other things. Go to the Milton Hershey webpage and see the tons and tons of candy products that he produces every day. Now, the question then becomes, let's suppose that we are tending toward some kind of a bias. Do we want to bias between aggressive? Do we want to bias towards conservatism? So what the Institute does in this section is said, you know what, we would much rather you push yourselves to conservatism in presenting these results because it provides protection. There is reduction in legal risk. Regulators and politicians have protection, and then there might be some tax benefits out there. So I would know all four of those benefits of conservatism. Now look, I'm not saying that this is what you need to be doing, but it's better to be conservative in general than not. Now remember, we had a whole conversation about disclosures and notes. And we've got some management section in there where the managers can say something like, you know what, this is what we were thinking. Okay, so there are two examples here. I think these are great examples: the big bath accounting and the cookie jar reserve accounting. So what these are the biased. These are biased in application of these accounting standards. So I would be able to say something like on the exam, hey, here's a scenario. Hey, that's Big Bath, or that's the cookie jar. Those are probably really good questions on the exam. Here's another great exam question here. You have a question stem where the accountants for a company, they do something, whether it's related to debt covenants or to mislead stakeholders or earnings targets, and then you'll have to kind of identify, maybe some of the actions that are likely to occur. For example, the question could read something like, hey, here's an accountant and he or she is presenting the financial statements to meet an earnings target. So what does that mean? Well, what are some actions? And there could be a whole bunch of different choices, and you would be able to say, hey, maybe they're trying to meet the internal expectations or maybe the external expectations. So make sure you know everything going down that left-hand column. These are really good potential exam questions. Now, the Institute has not ever, to my knowledge, have asked questions based on actual examples that have occurred over life. But I would be ready to know these examples and how they apply to what we're doing here in this particular learning module. So you're probably not gonna get an example on Wirecard or Enron or Ernst & Young, but you might get an example in which we're saying something like, hey, there's a trustee account, it's in some foreign country. What happens if they are found to be non-existent? So there you have some kind of an application of a real life example to a fictional example that would show up on the exam. This is a good exam question as well. This fraud triangle, what does this mean? Existence when low quality financial reports are issued. So you've got opportunity that can arise from within or without. You have pressure or motivation that can result from without and within. And then you can always rationalize there. You can always say something like, oh, the reason that I did this was, and you could list 27 different reasons. And maybe they sound like good reasons, but they're probably not. How about mechanisms that are going to prevent these kinds of low quality and low reporting? Well, look at all the regulatory authorities over there. You got registration, disclosure, auditing, you got all those kinds of things. And you have the auditors there, So don't think of Enron, right? Enron had the auditors come in, and the auditors, they were a part of all of those fictional financial statements. But the auditors are supposed to come in as independent evaluators of the company. And then private contracting. We'll talk about this at length in other learning modules, but think of this as a bank, right? So there's a bank that lends the company money, and there are covenants in there, which means that these are legal and binding contractual agreements. So legal, right? So we can go to court after all these kinds of things. That's why the Institute wants you to know about things like bankruptcy and liquidation and emerging from bankruptcy. We'll do that in another learning module. Let's move on to the next LOS, which asks us to describe presentation choices. And I'm pretty certain the way the Institute is going to test you on this is based on the boxes down on the bottom left. Part of this is that within GAAP and even without GAAP is that we have choices like I described earlier. And those choices then are probably very, very likely going to depend on the motivation by the managers. I think the Institute is going to say something like, all right, here is a decision that the accountants have made. Is this aggressive? Is it conservative? Or is it neutral? So there are your three choices. So I would make sure I would know these aggressive choices down there, and then the consequences of those aggressive choices, and also the conservative choices over there. Now we're going to dive a little bit deeper into those in the next handful of slides. But we have these presentation choices. So back in when I was an undergrad as an accounting major, and this was 100 years ago, I don't have any memory of kind of a discussion into non-GAAP stuff. My accounting professors just said, GAAP, GAAP, GAAP. That's all I ever heard. But late 90s, early 2000s, gosh, were you guys even born back in then? But, go back to the end of the Bill Clinton presidency here in the United States. There was a tremendous increase in economic activity, and this was reflected in stock prices. But this is back in the very early days of the internet. So there were these .com stocks that were taking off, like pet.com and rug.com. I mean, these companies, they experienced tremendous increases in their stock price, and they were not generating any kinds of revenue. So traditional valuation metrics, PE ratio, were irrelevant. So financial analysts and accountants came up with something else. So the first thing was to say, you know what, let's not take price to earnings or price to cash flow. Let's do like price to revenue or something else, some other way that we could kind of justify. So notice the terms there, eyeballs and stickiness, these terms are still around today. So what happened was then we had this need for other kind of metrics and other kinds of presentation of financial statements. And so there's some good examples down at the bottom. Excluding one-time expenses, amortizing goodwill. These are still problems in today. But one of the things that a lot of companies started doing is instead of taking the traditional earnings before interest and taxes and depreciation and amortization, and by the way, that EBITDA, that goes back way, that's back in the time of the Roman Empire, let's say. Well, of course, what accountants then did is they said, you know what, we like that thing, but let's adjust it. And so they adjust it by including some other kinds of things in here. This is a low probability question on the exam, but just take a look through those 4 examples and be ready that, hey, you know what, sometimes they can be adjusted, and these are the 4 most likely areas. The SEC, this is what I was saying earlier. Non-GAAP measures must be presented alongside. So what was I saying? What was that, 15 or 20 minutes ago? Here's Jim's depreciation method. I said, of course, use Jim's depreciation method. But what does it say? Must be presented alongside, and a reconciliation must be made. Now, there are some caveats to that. Look at the 2 checkpoints. You have prohibits excluding liabilities that require cash settlement, and those non-GAAP measures, they cannot be used to smooth or eliminate those recurring items. And the international people, they have similar kinds of rules. Now, getting into these final LOSs here, I think these are the great exam questions, potential exam questions. All right, so accounting choices. We've got tons and tons of revenue recognition, from the timing of revenue to stuffing to day sales outstanding to rebates to deliverables. So these are concerns by the analyst, be able to identify revenue recognition. And then, of course, depreciation methods. What can you do? You can change the lifespan. You can change the depreciation method. You can write down the assets. You can do impairment. You can do all sorts of things. And you can do the same thing for intangible assets. The depreciation is for physical assets. Amortization is for intangible assets. So you can do all that kind of stuff down there as well. Yeah, allowance for doubtful accounts, inventory cost methods. There's LIFO that I suggested earlier. What happens if the machinery becomes obsolete? What happens if people aren't paying us? I mean, you can keep an accounts receivable on the balance sheet for thousands of years and it still bumps up your total assets. But sooner or later, you're going to have to say, you know what, these people, they're probably dead by now. They're not going to pay us. So we need to write it off. And so that gets into all of those conversations that we had before on the loan loss reserves, et cetera, et cetera. Tax valuation accounts and goodwill. These are important from several different perspectives. the key element here under the tax valuation accounts is look in the middle one there, management commentary. So I said this a little bit earlier, make sure that you look at the notes, make sure you look at the management discussion in there to get a sense of, we have one set of financial statements for the IRS, we have another set of financial statements for the shareholders. How do we reconcile those two? So that's a big concern. The warranty, I've always thought warranties are kind of dull, but maybe they're not. You guys who are accountants, I don't know that I've ever had a warranty for like a refrigerator or anything that I've ever used, but I'm sure there are people out there that do. So how are we reflective of those costs? Related party transactions, this is a great extra link between what we're doing here and what shows up in the code and the professional standards. Do transactions disproportionately benefit management? Tons of those examples that we did in the professional standards kinds of a discussion. So go back here. Let me make sure. So go back and make sure you know all of the concerns and the accounting choices, and then be able to identify signs of manipulation. So this is kind of an application of what we just talked about in those previous slides. And by the way, now you guys that watch my videos, you'll know that I'm going to send you to the questions at the end of this learning module. There are 27 of them, and many of them are just one line. So you read one line, so that's kind of a definitional question. But the good questions are when they have 2 or 3 lines, and these are the applications. And that's what we're doing here. Various signs of manipulation, being able to apply these things right here are concerns to actual decisions that the accountants have made. So can you decide based on something that's given in the question stem about revenue recognition items, inventory signals, changing from LIFO to FIFO, using some other kind of inventory valuation method? What do declining or increasing ratios mean? How do we capitalize things? Make certain, and this is, I never say this in any of my recordings. I don't ever guarantee that there's going to be an exam question. But if I were to guarantee, it would be this one here, number 4, the difference between cash flow and net income. Remember that net income can be massaged and manipulated. Cash flow can be slightly massaged and slightly manipulated, but cash flow, this is super important, right? Other warning signs, some depreciation, write-downs, impairment, all those kinds of things. Fourth quarter surprises, that makes sense. Company culture and governance, restructuring and impairment. I talked about impairment just a little bit ago. And then mergers and acquisitions. Of all of these here, I'm not going to tell you which one I think is more important. If I were making up exams, I think, this is just from a test creation standpoint, I think it's easier to make up revenue recognition questions and merger and acquisition questions for the exam. So if you just take a little bit of my advice, make sure you know 1 and 9. And what we can do is we can end on MODA and what they were doing. And this is an auditor's report. Notice under bolding it says something like, we're not quite sure what's going on. This is not reflective of reality. And that takes us through this series of learning outcome statements. Let me just go ahead and repeat quickly. Go do those 27 questions. I promise you you can do those in probably, what's half of 27? 13 and a half minutes. So it's not they're not long questions, but I promise you they will go ahead and they'll confirm lots and lots of stuff that I've talked about here in this recording, and it'll confirm that you can do the definitional and the application stuff. So hey, have a great day. Thanks for watching. Thanks for putting up with me, and good luck studying.